Okay, so you want to own a bank. Money flows in from depositors, you lend it out at a higher rate, and you pocket the difference every single day without lifting a finger. A machine that prints money from money itself. Sounds simple. It is not simple. Here's the problem. Almost none of that is how this business actually works. And by the end of this, you'll understand why banking is one of the most heavily regulated, thinly capitalized, and quietly fragile businesses in the entire economy. Let's start with the entry fee, because you don't just buy a bank the way you buy a store. To open a new bank, you need a charter from either a state banking regulator or the Federal Office of the Comptroller of the Currency, and the approval process alone requires you to demonstrate $12 to $30 million in initial capital before regulators will even consider your application, depending on the size and market you're targeting. That capital isn't a suggestion, it's a legal requirement under something called risk-based capital rules, meaning you need real equity sitting there specifically to absorb losses, not just enough to open the doors. The application and regulatory approval process itself, involving background checks on every proposed officer and director, business plan reviews, and community impact assessments, typically takes 12 to 24 months and costs $500,000 to $2 million in legal and consulting fees before you've opened a single account. Add the cost of core banking software, security systems, and a physical branch or two meeting regulatory standards, and you're looking at another $3 million to $8 million just to be ready to accept your first deposit. Here's the first trap almost nobody sees coming. Banks operate under a structure called fractional reserve banking, where you're required to hold only a small percentage of deposits in reserve while lending out the rest. But this means your entire business model depends on depositors not asking for their money back all at once. Regulators require you to maintain minimum capital ratios, typically a common equity Tier 1 ratio of at least 4.5 to 7% of risk-weighted assets, and falling below these thresholds triggers immediate regulatory intervention, restricted operations, or in severe cases, seizure of the bank entirely. New bank owners often don't fully grasp that their capital cushion, the buffer protecting them from insolvency, is thinner than almost any other regulated industry, and a single bad quarter of loan losses can push a well-run bank uncomfortably close to that regulatory line. Now let's talk about what happens after you actually open your doors, because the operating bleed at a bank never stops moving, regardless of how the loan portfolio performs. Regulatory compliance, examinations, reporting, and staff dedicated specifically to meeting banking regulations cost $2 million to $5 million a year for a community bank, a cost that scales up dramatically for larger institutions. Deposit insurance premiums paid to the FDIC, which protects depositors and in exchange takes a percentage of your total assets annually, run $200,000 to $600,000 a year, depending on your risk profile and asset size. Technology and cybersecurity infrastructure, absolutely mandatory, given the sensitivity of financial data, cost $1 million to $3 million annually. Labor, including loan officers, tellers, compliance staff, and risk managers, typically runs $8 million to $15 million a year for a mid-sized community bank. Then there's the interest you pay depositors themselves, which in a competitive rate environment can run 2 to 4% annually on your total deposit base. Here's the economic reality that will define your entire career in this business. Your profitability depends entirely on the spread between what you pay depositors and what you charge borrowers. And that spread can compress dramatically based on interest rate policy you have zero control over. Here's the part the passive income dream skips entirely, and it's the part that actually explains why this business exists in the first place. A bank does not make money holding your deposits. It sells risk management and liquidity transformation, taking your short-term, instantly withdrawable deposits and transforming them into long-term loans that can't be called back on demand. Understand this, and you understand the entire structure of modern banking. On a typical loan portfolio, a bank might pay depositors 2% annually while charging borrowers 6.5% on loans, generating a gross interest margin of 4.5%. But that spread has to cover loan losses, operating costs, and regulatory compliance before a single dollar becomes profit. The deposits sitting quietly in checking accounts are the product on the surface. The interest rate spread and credit risk management underneath are the real business. Now let's follow $100 million in deposits and see how little of the spread actually becomes profit. A community bank holds $100 million in customer deposits, paying depositors an average of 2% annually, costing $2 million a year. That same bank lends out roughly $80 million of those deposits, keeping the rest in reserve and liquid assets as required by regulation, charging borrowers an average of 6.5%, generating $5.2 million in interest income. The gross interest margin is $3.2 million. But loan losses, even in a healthy economy, typically run 0.3 to 0.8% of the loan portfolio annually, costing $240,000 to $640,000. Operating costs, including compliance, technology, and labor, consume another $1.8 million to $2.2 million. What's left as actual net profit is often just $400,000 to $800,000 on that $100 million in deposits, a return that looks unimpressive until you remember the bank is essentially profiting from a spread it didn't have to put up much capital to create, since most of that lending capacity came from depositor funds, not the owner's own money. So let's run two versions of the same bank and see how differently this can play out. In the optimistic scenario, your bank grows deposits to $250 million over 5 years, maintains a healthy 4.5% net interest margin as rates stay favorable, and loan losses stay low at 0.4% annually due to careful underwriting in a stable local economy. Annual net profit reaches approximately $3.5 million, and your capital ratios stay comfortably above regulatory minimums, allowing you to expand into new branches and attract institutional investors looking for stable community banking returns. Now here's the realistic scenario. Using the exact same bank, the exact same starting deposit base, the Federal Reserve raises interest rates aggressively to combat inflation, and while you can raise rates on new loans immediately, existing fixed-rate loans on your books were locked in at the old, lower rates for years, meaning your interest income barely moves while you're forced to raise deposit rates immediately to prevent customers from moving their money to competitors offering better returns. Your net interest margin compresses from 4.5% to 2.1% within 18 months. At the same time, a regional economic downturn triggers a wave of small business loan defaults, pushing your loan losses from base 0.4% to 1.8% of the portfolio, a nearly 5-fold increase. Your annual net profit of $3.5 million doesn't just shrink, it becomes a $2.1 million annual loss, and your capital ratio drops close enough to regulatory minimums that examiners place you under a formal supervisory agreement, restricting your ability to grow the loan portfolio until capital levels recover. The operators who actually survive and thrive in this business long-term aren't the ones who grew deposits the fastest or offered the most attractive loan rates to win market share. They're the ones who maintained conservative underwriting standards even when competitors were loosening theirs to chase growth, who built interest rate risk management into every loan they made rather than assuming rates would stay favorable forever, who kept capital ratios well above regulatory minimums as a genuine buffer rather than the bare legal requirement, and who diversified their loan portfolio across industries and borrower types so no single economic shock could threaten the entire institution. A bank, at the end of the day, isn't really a business that holds your money at all. It's a highly leveraged risk transformation machine wrapped in regulatory constraints, where the interest rate assumptions baked into a single loan portfolio, made years before a rate cycle or economic downturn ever hits, decide who actually survives long enough to see the bank through to the other side.